Recording in progress. I don't know if you heard that.
Got it.
All right, so I had made a quick call to Mike Ray this morning because the Fed met last week and agreed that interest rates are going to go up. And I wanted to do a quick little video to share with all the savvy agents about rate locks and what they mean. And I had some questions that we as agents don't know, but Mike can answer. So the first one was, if it's a 60-day, no big deal, lock your rate. Do it as quickly as possible. Advise your clients to do a rate lock because, Mike, you said over the last week, rates have gone up.
Correct. In the last, I guess, week to 2 weeks, we've seen rates go up at least a half a point, kind of middle of January through now. As the worry about inflation and the Fed's meetings has been building, we've seen rates continuously climb. So
Okay.
what was once 3%, middle of this month is now 3.5.
So the reason we're doing this quick little video is not for well, it is for our clients who need to do a rate lock for the short term, but it's more for the long term. Often at Savvy Company, we say talk to two lenders, have them work on the values, especially if you're looking for something that's months and months out. Like if you're doing new construction, you may, Mike Ray may be your go-to lender, and you may also be talking to the lender at the new construction place. And when you decide to do a rate lock, that's when you're in bed with the lender. You pay for the rate lock. So if you're doing a new construction, say your clients are maybe 4 months out from their build being complete, and the Feds have met, you watch this little video, what are your action items? So you're going to talk to Mike Ray or whoever your lender is, and the lender from the new construction, and you're going to find out what they offer for rate locks. And can you explain what types of things we may see with a rate lock that are beyond the standard 60 days?
Sure. So normally what you'll see with an extended rate lock is the ability to lock in at current market prices plus some type of add-on to today's rate for that extended rate lock. You can do as little as a 4-month rate lock all the way up to pretty much a year's time. But the shorter the rate lock, the less I guess, add on to that rate that you'll see. So if it's only a 4-month rate lock, you may only see, current market rates plus another 1/8 of a point or 1/4 of a point, all the way up to maybe a 1/2 a point or 5/8 of a point on a, year-long rate lock. But what typically happens is that you'll have an upfront fee. So when you do lock in on an extended rate lock, you are picking that lender, you're picking that rate. And it essentially locks in at that higher interest rate for however long your rate lock is for. The key with new construction is knowing when that project is going to be complete. And I know that's always a hard, target to nail down, especially now with shortages and delays. But if you pay for an extended rate lock and time passes that extended rate lock period, you lose the ability to have that secured rate. So really knowing, coordinating with your builder, coordinating with the listing agent on, when this property is going to be complete before you actually pull the trigger on that rate lock is going to be, half the battle. But once you do lock in, typically your buyer will be paying, either a 1/2 a point or 1% of their loan amount up front, and that is the kind of fee to secure that rate lock. That upfront fee is typically refunded at the time of closing, or it gets applied towards their closing costs. So if you have a $400,000,
and say,
yep.
Some lenders don't apply at all. Some lenders keep half of it and or apply the other half to your loan amount. So that is a question to ask.
Double check with your lender. Everybody does it a little bit differently. Here we would apply the whole balance towards your closing costs. And if you also have any type of concession, either seller concession, builder concession, or even a realtor concession, that upfront fee can be refunded to you actually as a check back at closing. So, a lot of times you'll have a lender credit or a builder credit if you're doing new construction. Paying this upfront fee essentially locks in that extended rate. If you don't have enough closing costs to have that full amount refunded back to you after backing out any type of builder credit or lender credit, then your buyer will get that money back. But every case is different, so make sure you understand before make sure your buyer understands before they're locking in what exactly they're going to be looking at as far as fees.
I'm going to ask Mike a very unfair question. I know how unfair it is. We've seen that the interest rates have gone up in the last couple of weeks. The Fed met, they said they're going to continue to go up. Is now, are we at a moment where pause, stop everything, do a rate lock if you're closing in 6 months?
You know, that's a hard question to answer. It isn't fair, but I do think that, you know, a lot of times when we leave a Fed meeting, you know, so they met last week, you know, their meeting minutes came out last Wednesday. A lot of times it's a knee-jerk reaction. So a lot of the bump up in the rates that you see is instant. You know, everybody's scared, the market falls out, you know, rates go up, and then slowly it kind of settles back down. So if it was me, I would definitely be looking into what the cost involved would be on a long-term rate lock, and if it makes sense to do. If it's, you know, for only 6 months time period, it's not going to be half a point on top of current market rates. I mean, if you're able to lock something in under, you know, 4% and have that secured, I think that that's a really good option. But I do think that we'll see a little bit of a settling down. I don't know if it's worth risking though. It's a whole lot easier for rates to go up right now than they are to go down.
So I want to talk about the risk a little bit. So if you do a rate lock and let's say you rate lock at 4%, and when you're closing, it's at 3.5%. You're going to be paying closer to that 4% because you get a little bit of a penalty, a little bit closer to the 4% than you would have if you hadn't done a rate lock. So there is some risk involved. What percentage is that? It's like points.
So with an extended rate lock, if you do lock in at 4% and the market rates, you know, within 30 days of your closing date are lower than that extended rate lock rate, you have the ability to float down to current market rates plus typically 1/8 of a point. So if market rates are at 3.5, you know, you would be locking in at 3.625, which still would be far better than the 4% extended rate lock that you secured. So when you do an extended rate lock, you know, ideally you're securing your worst case scenario pricing, knowing that if, you know, the rates increased over that extended rate lock rate, you know, you're protected. And if rates are still lower than that extended rate lock rate, you know, more better too, you get to float down to whatever the current market is plus that little 1/8. But ideally you're going into it knowing worst case scenario pricing. And that really helps with, you know, calculating payments, knowing that, you know, your payment's not going to be above X. Now, the only dilemma or downside to that with that new construction would be if there's any delays with, you know, having the certificate of occupancy or actually getting the loan closed within that rate lock period. So if your builder tells you 6 months, I would probably be looking at an 8-month extended rate lock just to buy that extra 2 months of protection, knowing that we're typically seeing, you know, delays in construction.
Love it. That's super good advice. I appreciate your jumping on.
Yeah, absolutely.
I felt like now is the time to at least say something about what the Fed had to say and how it affects people. So definitely, if your clients are looking at closing in the next 60 days, rate lock, period, end of story, do it.
Yeah.
There's no penalty for that. It's the more long-term ones that you have to kind of maybe hedge or try to make the most educated guess you can on what to do.
Have them have that conversation because it may be something worthwhile doing, or it may be something that you can wait a little bit longer on, especially if you don't know when that project's can be completed. But it's definitely worth having that conversation now to make sure that, you know, there's not a big shock in 6 months' time when rates are at 4.5%, and, you know, they could have done something about it.
Yeah, awesome. And so another random question from my brain that popped in. If somebody's pre-qualified for a $600,000 house and they're building a $600,000 house and it's based on the current interest rates, what happens if the interest rates go up like 2 points? I guess not 2 points. 2 points is the wrong.
That'd be a lot, but a half a point could have a difference on a $600,000 loan. Ideally, they still qualify. If they're at the very tip top of their budget and their price range, then you need to start looking at what options you have, either, you know, paying down or paying off other debt to lower that total debt ratio in order to keep them qualified at a higher interest rate. Maybe look at buying down the interest rate, so paying points to actually lower your overall interest rate to still qualify. looking at possibly getting gift funds for more of a down payment. It's not a fun conversation to have, but definitely one that we may start seeing, especially if your buyer is qualified at the absolute max of their budget. But the other side of that coin is that they may have had a raise. There may be some bonus income you could possibly use to help, with your numbers. But it is something that if they are in a new construction contract, keep in touch with their lender, keep in touch with your buyer, make sure that nothing material has changed with job, with income, with debt. Maybe they had to go out and buy another car or something like that. But if we do see rates, continue to climb and they were qualified at the max of their budget, that number is going to go down. So we need to, step back and figure out what exactly they are qualified for now.
Super helpful. I appreciate your time today.
No problem.
It was
Good luck,
very last
everybody.
minute. I was like, Mike, I want to make a video. And you were all about it. And I appreciate
Yep.
it very much.
Happy to help.
Oh, one more question. What is it costing to now to pay down points?
Every day is different. So points are part of our daily rate update. So when we get rates every morning, we'll have all the rates listed and then what points are kind of for each lower rate. So it could cost a half a point. It could cost, just an eighth of a point to buy a rate lower. It could cost 2. Every single case is different. It's credit driven, it's income, or not income driven, it's credit driven, it's loan amount driven, a lot of different factors, but it's very easy to kind of run those scenarios and then also run kind of the analysis on it. So if you did buy down the points, how long would it take for you to recoup those costs? If you can do it in less than 5 years, which is typically the cycle that you see somebody either buying or refinancing, then it may make sense to do. But if it's going to take them 8 years or 9 years to recoup the cost of paying that rate down, then it may not make sense to do. Take the higher interest rate and roll.
Awesome. Thank you so much.
Yep. Thanks, Jenny.
Okay, we're going to post this on our internal Facebook thing. So you may have questions. What's your phone number?
704-724-9997. Email is mikeray@atlanticbay.com.
Awesome. Thank you
Thanks,
so
Jenny.
much. Bye.
See you.